Over cheap Chinese electric vehicles. They've upended the global car industry. The United States is proposing a ban on electric vehicles and connected car tech from China, while the European Union is set to decide today on hiking tariffs. Hungarian Prime Minister Viktor Orban says that could spark an economic Cold War.
What happens when protecting your own industries backfires? What if a move meant to safeguard jobs ends up threatening them instead? Right now, that's exactly what's unfolding in Europe. A major trade clash with China is shaking up the $40 billion auto industry, and the fallout is hitting hard, from rising EV prices to delayed climate goals. Let's break down how this all started, where it's heading, and why it could impact everything from your next car to the continent's clean energy future. In April 2025, the European Union stepped up its fight against cheap Chinese electric vehicles. New tariffs, some reaching as high as 38%, were slapped onto EVs from brands like BYD, NIO, and XPeng. These Chinese manufacturers had been undercutting European car makers with prices nearly 20% lower, made possible by heavy government subsidies. The EU's goal? Protect its auto industry, worth $40 billion and crucial to countries like Germany, France, and Italy. This move sparked a chain reaction. Because China didn't just take the hit. Instead, they started turning the screws on Europe's supply chains, slowing down shipments, raising prices, and tightening the flow of critical parts. And here's why that's a big deal. China supplies more than half of the essential components used by Europe's car makers, things like lithium-ion batteries, rare earths for electric motors, and semiconductors. Volkswagen has taken the brunt of it. According to Bloomberg, about $10 billion in EU imports are now affected. That includes 30% of the batteries and 20% of the chips Volkswagen depends on. Factories in Wolfsburg and Pamplona are already seeing disruptions. And it's not just VW. Renault, BMW, and others are feeling the squeeze too. So, what does all this mean for you? First, get ready for higher prices. As Chinese parts become scarce and expensive, European automakers are struggling to keep production lines moving. Bloomberg estimates that EV prices could jump by 10 to 15% by early 2026. That means a $32,000 Volkswagen ID Pi 4 could cost nearly $5,000 more. A premium Audi Q8 e-tron? Up to $12,000 higher. So if you were thinking of switching to electric for savings or sustainability, that goal just got harder. We've seen this before. In 2021, chip shortages pushed car prices up by 18%, and we're heading into familiar territory again. Second, there's the risk to jobs. Europe's auto industry supports over 2 million workers, especially in Germany, Spain, and Hungary. Volkswagen alone has 280,000 employees. Reuters reports the company is already warning about shift cuts. Smaller suppliers, like battery makers in Poland or chip factories in Belgium, are even more at risk. And when production slows, the damage ripples. Local stores, cafes, and service businesses around factory towns feel it too. Third, and maybe most seriously, Europe's clean energy future is at stake. The EU wants to cut emissions by 55% by 2030 and ban new gas-powered cars by 2035. EVs are central to that plan. But without a steady supply of batteries and chips, production stalls. That means fewer electric cars, more gas cars staying on the road, and delays in meeting climate targets. It also slows investments in related projects, like charging stations and renewable energy infrastructure, which often rely on the same parts. So how did this trade clash even begin? For years, Europe and China had a mutually beneficial trade relationship. Europe relied on low-cost Chinese parts. China benefited from strong export markets. But that changed by 2023. Chinese EV makers, particularly BYD, began dominating Europe's market with cheaper, more advanced vehicles. European brands couldn't keep up. To defend its position, the EU launched an investigation and imposed initial tariffs in 2024. Those grew stronger in 2025, reaching up to 38%. But instead of retaliating with their own tariffs, China took a smarter route. They tightened their grip on the supply chain. According to Bloomberg, China controls 75% of the world's EV battery supply and 80% of rare earth materials. Rather than going through the WTO and risking legal trouble, they simply slowed down exports and raised prices, applying pressure exactly where Europe is weakest. And this isn't a new tactic. In 2010, China cut rare earth exports to Japan. In 2019, they delayed U.S. farm goods. Now, they're using the same playbook against Europe. So what happens next? In the short term, Europe's automakers are in a bind. Volkswagen warns it could cut production by 9% by November 2025 if the parts don't start moving again. At one point, Reuters reported that $8 billion worth of parts were stuck in Chinese ports, costing Europe $400,000 a day. Dealers are also bracing. Delivery times could stretch from 3 to 6 months. Orders for EVs like Skoda or BMW are already being delayed, and buyers, especially families on tight budgets or first-time drivers, are the ones who'll feel it the most. To make things worse, banks may raise car loan interest rates, making financing even more difficult. Bigger concern? Europe's dependence on China. There's a plan to fix that. The Critical Raw Materials Act. It aims to boost domestic battery production to 25% by 2030. But right now, Europe only produces 10% of its own batteries. Rare earth processing, even less. Projects like Renault's battery plant in Sweden won't be ready until 2028. Until then, Europe remains exposed. And China knows it. And while Europe scrambles, China is building ties in the Middle East, Africa, and South America, making it even harder to replace. The economic stakes are massive. A 2024 study from the European Commission warned that even a 20% supply chain disruption could wipe out 1% of EU GDP. That's $180 billion annually. That's not just a hit to the car industry. That's a blow to jobs, exports, and long-term growth. So, what are Europe's options? At the upcoming WTO summit in July 2025, the EU might try to negotiate. That could mean lowering tariffs in exchange for China easing export restrictions. But China is expected to demand significant concessions. Another route is to diversify suppliers, like sourcing batteries from South Korea or rare earths from Australia. But Reuters says that switch could increase costs by 12%. There are investments being made, $12 billion to support local battery and mining projects, but most of that won't pay off until the late 2020s. In the short term, the EU may offer tax breaks or subsidized port fees to help automakers manage. But these are band-aids. The deeper issue, over-reliance on China, remains unsolved. To sum it up, the EU's trade fight with China is disrupting Europe's $40 billion auto industry. Major players like Volkswagen are under pressure, car prices are rising, jobs are at risk, and Europe's clean energy transition is slowing down. This isn't just about trade, it's a test of economic resilience, energy goals, and global influence. Every fact in this breakdown comes from trusted sources like Reuters and Bloomberg, verified, clear, and focused on what matters most. The situation is still unfolding, and its impact will stretch for years. With that said, thanks for watching, and until next time.